Hi, hello, welcome friends. In continuation with the last class, so we are discussing about fund accounting classes. So now I will continue with the last class. So we have different strategies in here. One strategy will be venture capital strategy. What is there in this venture capital strategy? What we need to consider in venture capital strategy? First of all, in venture capital strategy, the strategy is the fund will invest in startup companies, which will invest in startup companies always. So startup companies, it will invest in startup companies. Here the startup companies means the business with how new and with how innovative ideas where the products or services is new in the market, and success of the product or services depend on the various factors. There may be some customers may acceptance by the product, or some may not accept, or some may require helping of people problems. So same like has, so that type of startup companies innovative ideas. If you see for Lahari movie, Chitra Lahari movie. In that movie, our hero invented one device which will be useful for all the type of products. Some may criticize, after some may use that products. This type of product will be there in this. So if you invested in that products, it will known as venture capital strategy here. And generation of more ideas, has the capital with no money and technology. So these people have idea but they do not have the money, and so that they will go for some persons and they will invest in their product. Then who provide capital, he is taking the huge risk of losing all invested capital also sometimes. So if the product launched, idea is the different person, the idea is if it is not worked as how they expected, then all money will be loss will be happen. So huge risk will be there, and this PE and venture capital will have experience in dealing this type of similar business. So in other countries, and they have experienced people in their team, they can judge the idea and possibly success. So they invest along with money, and they will support other requirements. What is the technology it will require, what are the approvals will be required, what are the government approval will be required, this type of helps also they will do. This is known as venture capital strategy. So here venture capital strategy, if you are starting, if you are startup and you need money for your business, the source will be different source will be there. The main sources will be, one is bootstrapping. Here bootstrapping means one source of the founder, who is person. If you are starting your own business, you have some savings, you have some friend support, etc etc. Another will be angel investors. So angel investors is the persons who is the individuals having net worth persons who have more money. They will invest in small money, and they will support their experience around 2 to 3 years. Up to 2 to 3 years they will support. After that you need to grow up. So like Reliance Ambani persons, or Rakesh Junjunwala and other persons, TCS Info, Sudha Murthy madam, or any other persons who have more money, they will invest. Here they known as angel investors. And another one is venture capital. What we had discussed now, they will use they will invest in startups. These are either may own source of this firm, or they will pool money from the investors. Like they will go for different partners, they will collect money and they will establish venture capital. This venture capital invested in startups, and this is still at seed stage. This have different stages will be there: seed stage, magazine stage, and development stage. So different stages will be there. Whenever at the time of giving the capital, it is known as seed stage of the company. So seed the capital, if the business is the less than 5 years or 3 years will be there, and this sources works and need capital is less than amount whatever required. And another source will be private equity funds. Private equity funds means here pool money from investors. They invest huge money and to grow the business, grow up business, like they will introduce the business and in other cities and other countries they will go for that. And after that you can have an option of IPO, that is initial public offer. Initial public offer means you will list your company by listing in stock exchange. There the persons, investors will buy that shares and give that money amount. And if you are not interested in going for IPO, or you can share your sales in public and you can list in stock exchange. And most of the activities this was, if you do not have idea now, so the investment banker will take care of this. So these activities may also done by this mutual funds, hedge funds in this market. Here whatever the company, same earlier investors may exit by selling their shares. So some in IPO also some persons will come for just to make a profit. They will enter into market and they will exit in middle itself. Or we can see that angel investors, so they will come and they will invest and after some time they will exit from the market. Here funding will be happen only first time and second time. So here they may have fundraising etc. So you need to prove in that stages only. So if you are asking always asking money, they will not give. They will see only first time and second time. So after that you need to grow up on the own. Most of these startups will go in a, just a second here. Yeah, what happened? What happened here? Just a second. So come. Mm, mm. Okay. So here they have the most of startups investment will give losses in the funds, but successful investments or exits they will sell the investment to cover all the losses for these companies at a low prices. Here they may be have different strategies also. So one will be pipe. PIPE means private investment in public equity. Here in this strategy, these funds fund invest in public companies. So what they will do, they will invest in public companies or listed company shares, and these companies are already established and have less risk. And here the main idea of the fund is to make profits if the share price is increasing more if the company announces any new business or expansions. So here private investment in public equity, that is pipe. Here what they will do, here the strategy will be funds invested in public company or listed companies who have already good image in the market because they are already established person now, so that they have less risk. And main idea to make profit only, and when the share price is increases, when the company is expanding. And after that one strategy will be fund strategy. Fund of fund strategy means one fund will invest in other funds, rather they will directly investing into company, they will go with the other funds. So we do not think more about that funds. Here they will go. and here they will go for the diversification or use the expertise of the different asset managers. They will do the type of fund of fund investments. So popular strategy will be fund of fund. Reasons will be two only: one is diversification, one is expertise different asset managers. So for example, I am maintaining the fund relating to real estate. So I am maintaining the real estate fund. So I am expert in this real estate fund. So some other person is expertise in another fund. So another type. So if you want to enter into real estate, why should he waste his time? So he will invest in this fund. So he this fund person invested in this fund. So fund of fund strategy. And leverage buyout, here the leverage buyout strategy will be uh, leverage buyout strategy will be, in this case the fund will buy out any existing company. So they will help borrowing capital and they will make the profit. Here what will happening the for leverage buyout means, here the persons whoever is there, they will think about price is going down in 1 month or 2 months or 3 months. So what they will do, they will borrow some shares. Now itself borrow and they will sell in the market, and after 1 month they will buy the shares, so at low price. Here they will sell with high price. From they will buy at low price and they will give to this persons plus interest. So here they have sell at high price and they have buy at low price and they will pay interest only. Here they will get the gain or profit. This is known as leverage payout. And different strategies also will be there, that credit strategy. Another one will be the credit strategy. What is there in credit strategy? In credit strategy, invest the in bonds and get interest income. It is very less risky. So credit strategy means simply you need to invest in bonds and you need to get the interest income. There is no risk. Then venture capital. And another one is magazine strategy. In magazine strategy, here invest in convertible debentures, that are convertible warrants will be there, and where the fund will get interest fixed income for some time and later they will convert it into shares. So that is known as this magazine strategy. Here you will get the 2 3 years or 5 years up to starting level they will pay the interest. After that they will convert it into shares. So then you will become the part of that management. And next, distressed strategy. Distressed strategy means here the fund will invest in loss making and trouble companies who have distress in their company name, and so they buy at cheaper valuation and make profit by selling at profit. So whoever is going down, if you see that person, Lalita Jewelry person. So Lalita Jewelry person, he has buy that Lalita Jewelry when the market, when the that Lalita Jewelry is in low profit, running in a low profits, and is, which is in a trouble company. So he has buy that at cheaper valuation. Now he is making more profits there, and he is not sell as of now. He is running the business only. And investments valuation will be related to disclosures in books. They will have fund accounting. So which accounting will be needed means how to book or what will be reporting in the fund books. So we always book in market value. And here when some assets we do not have the market value, we will go in a sequential way. We have level 1 and level 2 and level 3. In level 1, level 2, level 3, what is there in level 1, level 3, level 2 means, here when do not have the market value properly, we will use this level 1, level 2, level 3. In level 1 we have market value are considered based on some active markets will be there. So here active markets means if you go for the stocks, active market means that's NSE and one BSE. So National Stock Exchange or Bombay Stock Exchange. So from here they will take the market value of the price. Here the active market is there, and here the thousands of buyers and sellers will be there on a regular basis. So it is trustworthy. Here the price will be less risk, whatever the company discloses, whatever the fund house discloses, that price, sale price will be correct only, reliable only. This is level 1. And after that level 2, here of level 2, where in first we have active market, so we use that value, and in level 2 we do not have the active market of the product which we are dealing. Now we will go from identical products or similar assets of this asset in the same month or a day, and so there is no difference between that value. For example, if we are want to sell this building, is this building market value is not there, we will go for a similar building which are sold in 1 month later, 1 month back, we will go. In level 2 it will happen. So in level 1 we will go with the active market, level 2 we do not have active market, so we will go for similar assets. In level 3 what will happen, we do not have the active market and we do not have the similar products. Now we will go with the valuation. Some assumptions will be taken and some different valuation techniques will be adopted, and here the price whatever chosen will be high risk, and here some projections will be taken for that 5 years projections, and what is the cash flows will be there, and for that cash flows we will use the discount cash flow method. For whatever the inflows will be there, whatever the outflow will be there, we will discount that amount and we will arrive the value, that is in level 3 valuations. So we have three valuations: level 1, level 2, level 3, when we do not have the exact value of that product. And after that we have introduced that DCF means, this DCF means discounted cash flow method. Here discounted cash flow method, if you have any expected return and you know that shares or assets will give some amount in later amount, now how much amount you need to pay. So after 2 years you need to 2 lakhs, so how much you need to invest now, that is the present value. What amount you need to outflow as of now, you will get from this flows. So you need to, if you invested 1 lakh and after they will give the 10% returns, so calculating that cash flows and discounting that cash flows present value, you will get the whatever amount you need to invest as of now. This is known as discounted cash flow method. And after 3 months what will be there, and after 1 month will be what will be there, and we need to post that entries will be required in fund accounting books for that. Now here financials will be prepared, and for financial preparing this mutual fund, daily NAV will be need to calculate, first one. And next one, this mutual funds will prepare the financials based on semi-annually on financial annual financial statements will be required. And where has private equity, here and the private equity normally monthly or quarterly reports will be there, some unaudited balance sheets will be there at monthly or quarterly statements we should know, and if yearly filing it will be audited financials. Next, hedge funds. Hedge funds means generally this monthly financials. Next, here who the participants will be there in NAV reporting, means there are different persons will be there in NAV reporting. For they have, we have discussed that person: fund administration, fund house, administrate, audit firms, mutual funds, etc., etc. These persons will be involved in the financial cases, and we are, there may be what are the sections will be included in the financial statements. So in financial statements, so fund house financial statement, we have mainly SOA, that is a statement of assets and liabilities. Here we have balance sheet having assets and liability details. Next, SOO, that is so statement of operation. Statement of operation means in our term profit and loss with the details like income, expense, net profits, etc. And after that we need to cash flow statement. Cash flow statement means here explaining the source of cash and application of cash in the funds. And after that we should have schedule of investment. In schedule of investment we have details where the fund is invested, what is the market value of each investment. This market value only we have three levels na, level 1, level 2, level 3, what we have discussed before this concept. And percentage of investment will be there, and NAV of the fund, country where the investment is made, and securities, shares or funds purchased in the company. And next, what is the statement of changes in partners capital. So partners, general partner, what is their unlimited partners, their opening balances, what is the amount allocated to them, what is the expenses will be there, and what is the closing balance, what is the NAV of that partners. So these amounts will be there. And another one is notes to accounts. So these are the documents. This will be included in financial statement. In notes to accounts we have details like risks of the fund, what will be there, that is credit risk, liquidity risk, accounting policies followed, and how the investments are valued, fair value hierarchy will be there, financials highlights, they are IRR and expensive ratios, and how management fee was calculated, how incentives were calculated. This all information will be required in notes to accounts or footnotes. This is will be there. And that after that here what these funds, which law they will follow, either a gap they should follow, or either IFRS they will follow, or US gap they will follow, or Luxembourg gap they will follow. Generally depends on where the fund is registered is the main importance. So for fund using the gaps, for fund using, for where it is registered will be required. So registration is required. For example, to they follow local gap, like US based funds follow US gap only. So if you are in US, you need to follow US gap. If the fund is registered in Luxembourg, you need to follow Lux gap. And if master is registered in US, they will follow US gap. And if the master is there in another country, and they will follow their accounting gaps only. And if you are in different places will be there, and different local gaps will be required to follow. And this US gap, Luxembourg gap, Lux gap, IFRS, you need to follow based on where you are registered. So that will be there. And here NAV life cycle, we have discussed that NAV will be there, and that NAV life cycle. In NAV life cycle, any company's financial statements, that preparation, fund also follow some steps need to follow. And they will, some cases they will give that outsourcing of work to fund administrations. Here what they will do means, in NAV life cycle they will first post all that bank related entries. So bank related entries, that like what is the capital received from investors, what is the investment by the fund, what is the expenses paid, what is the incomes received. So that all bank related entries will be posted firstly. And after that adjustments they will do. So they will do the adjustments entries, increasing or decreasing the investment value, means we will need to follow the market value now. That the reason we have discussed about level 1, level 2, level 3. So we need to follow that level 1, level 2, level 3 if do not have the market value exist. And we need to update that adjustment entries to every investments. And expense, whatever the payable is there, accrual is there, major expenses will be this management fee payable, art fee payable, and incentive fee payable, etc., etc. This adjustment will be there in next cases. And once the all entries was posted, then we will go for the general ledger will be ready, and after reviewing this, checking those general ledger will be accuracy, then will be closed. So first we will bank entries, after that adjustment we will see the general ledgers, and after this trial balance and supporting calculation will be seen. So trial balance will be, and supporting calculations will be that supporting calculations means that management fee calculation, incentive fee calculation, whether calculated properly or not, management fee taken on NAV or not, incentive fee taken or not, hurdle rate considered or not, we will check on that supporting calculations, including that monthly pack, quarterly pack, and which is sent by the house for review. And here if the trial balance and or the administrator was prepared, by taking this trial balance, the fund administrator will prepare the financial statements. What are the financial statement will be included? We have discussed that SOE, that is statement of assets, liabilities, statement of operation, statement of in SOE. So that all we are discussing now. Statement of operation, statement of assets and liabilities, statement, schedule of investments, and cash flow statement. Then the fund administrator will prepare based on the information what we are giving. What is the information we are giving? Bank related information and adjustments and trial balance and supporting calculation we will send, and our fund administrator will prepare the financial statements and notes to accounts. So notes to accounts, we have the funds like credit risk, liquidity risk, accounting policies what we have followed, that all will be there. And after that, here the fund administrator prepare now financial statements, and he will finalize the fund level incomes and expenses of each investor, based on finalize the NAV of each investor. So those number of allocations file are used in the capital statement. So that capital statement is also known as PCAPS. So PCAPS. So once fund administrator finalize the NAV, this NAV will use this in PCAPS. So partners capital account. In of case of PE or hedge funds will be there, and in PE and hedge funds separate capital statement will be provided to each partner. And here because the in PE and hedge funds they have less number of partners and they have high net worth persons, so they will need to send the each partner capital account PCAPS. And here we need to prepare the books of accounts, whatever the books of accounts we are preparing, and we need to post that all entries in general way we need to prepare. And when if there is any negative NAV, if you have any negative NAV, is it possible? First of all, in mutual funds or hedge funds where money is collected at the time of launch itself, so NAV is never be negative in mutual funds and P that hedge funds. So in these both cases, this NAV will never be zero, never be negative, and negative, and unless some cases it may be zero. But in case of P, I think better to go. Just a second here. Irritating that one. Okay, it's better some. Mm. In this what we are discussing in, we'll continue later here.